Kerr Neilson is widely regarded as one of the most significant and original investors Australia has ever produced. Born in Johannesburg in 1949, he bought his first shares as a teenager, studied commerce at the University of Cape Town, learned the craft in London during the turbulence of the 1970s, and then moved to Australia in 1983. A decade later, he co-founded Platinum Investment Management, a firm that would go on to reshape how Australian investors think about global markets. But the story of Kerr isn't just about performance. It's about temperament, independence of mind, scepticism of the crowd, and a lifelong belief that price and value are rarely the same thing. Across 5 decades, he has navigated crashes, bubbles, and profound structural change, building a reputation for thoughtful judgment, emotional steadiness, and the quiet courage to stand apart when it matters most. Kerr, it's a genuine pleasure to have you on our program and to be in your residence here this morning. As I mentioned, born in Johannesburg in 1949, and you've described previously as coming from a family of inventors and industrialists. Tell me about your childhood. Tell me a little bit about the family history, if you could.
I'll try and keep it short. We had this one remarkable fellow who discovered a way of improving the yield out of a blast furnace by preheating. And that set the family up for several generations, because they then went into producing steam engines and steel, and they migrated back into the coal mining industry. So they were quite big industrialists in Scotland, which at the time was the biggest industrial city in Britain. And so that was the origin, and that sort of lived with one from one's early years, because this was a reference point. And it was a sense of pride, because it was a fantastic innovation, and he was protected by a patent which he had to uphold at a cost of 10,000 guineas when it was challenged, which was a huge amount of money in 1840. And anyway, he kept them, and he was getting paid a shilling a tonne, of which he shared with his partner. So as a family, we got 6p a tonne. Not a lot of money, but remember in those days, a workman literally made a few shillings a week. So it was a huge fortune. And they then went and become quite flash, and they bought these houses and fancy cars. And in the First War, they donated 2 of their Rolls Royces, or the 2 Rolls Royces they had, to help Lawrence in Mesopotamia and so on. So that was the history. And on my mother's side, they'd made a lot of money out of planting. So they were the early planters in Malaysia. And so one of them was a very good linguist. So he's responsible for bringing the Tamils. Largely he alone was responsible for bringing the Tamils from Ceylon and South India into Malaysia. So it's quite an interesting history of entrepreneurial drive.
And your own childhood growing up in South Africa, take us inside that. What sort of stands out to you, and what was that like?
South Africa at the time was, I'm talking about the 50s now, was really quite peaceful. The nationalists had just come into power, and there was very little conflict on race grounds. The Afrikaner gradually took on more power, because they won the election with about 60% of the electorate being Afrikaans speaking, and replaced most of the British institutions and leadership with their own people. And that was fine. And so gradually the influence of English-speaking South Africans diminished, and the Afrikaans speakers prevailed. The problem at the time, though, was that the Africans were flocking into the cities, and there was no influx control, and they brought that in, and then they had to enforce it with what became known as the pass laws, which gave the police the ability to stop and search at random. And this led to all sorts of abuse and got worse and worse through time. And it was this fear of being overrun by the Africans that led to the apartheid becoming more and more stringently applied and unfairly applied. So that was the environment we were brought up with, and many of us had servants. The white ruling class had servants, and you'll chortle at this, but it was true. We had at one stage, I think, about 5 people working with us. And but it was largely to give them jobs because they were coming from the land. They would neglect their crops because, the menfolk were away. And so it almost became essential they came to the cities. And so it wasn't the greed of the employers. It was simply saying, well, we have a social obligation here. And remember, there was no social security. That's a modern invention. Even now, it's in Africa, it's insignificant. So it was an interesting environment where there were the English and the Afrikaans speakers. There was one division, and then you had the colour division. And if you went down to the Cape, you had the Malay, those who'd come from Malaya, those who'd come from India, and so there were groups of. It was a bit like modern day India. Huge number of colonies, if you like.
You bought your first stock at age just 13, which suggests, at least in my mind, curiosity about ownership and enterprise at a very early age. What first drew you to that?
Well, this idea, that we'd been in industry, and then my mother ran this rather hopeless portfolio, and she sort of would follow what everyone else was doing. I thought this was a bit random, but she seemed to do okay. But there was no structure. It was all, he says it's okay, so I'll put some money there. But it gave us exposure to markets because without that, you would simply see it as someone else's business. But by having it in the family, and that's why it's so important that, that you convey to your children a sense of togetherness with something rather than it being foreign. And because we were so privileged, and knew it, and were told we were privileged, and were very aware that with the privilege came obligations. Because of that upbringing, it changes your whole point of view. So it was really quite evident that we could do things that many people might have thought as foreign. We didn't think it was particularly strange it should have an equity participation.
You graduated high school. Before we get into your university studies, what would we find if we were to look back on that period? What sort of person were you? Would we find somebody prior to university that was interested in business and markets, that was already thinking about commerce, or would we find someone that wasn't sure about where their place was going to be in the world?
One never thought of it in those terms, but there was a very good publication called the Financial Mail, and that would run articles on companies. So you started to sort of ingest a whole lot of stuff about business. My father was the most brilliant salesman, but a useless businessman. And I could say that to him today if he were alive, because he was trusting and he was generous and he was kind and what have you. But he didn't care about, he just loved the idea. It wasn't the making the money ever appealed to him. It was all about the connections. So we didn't get much help on that score, but where we did get the idea was he was an entrepreneur. He was trying to do interesting things in his time. So that was what was guiding me. And no, I was just another sort of, 16 to 18-year-old lout. And then you go into the army, which was a whole story of itself. I mean, you met people who, some had not been given any education. And this was in the days of conscription. So you were sitting with people who were twice your size and 10 times your strength. And they wouldn't bother with eating implements. So it was a very good sort of leveler. You certainly knew, how lucky you'd been.
Obviously, that was compulsory conscription.
Conscription, yeah.
Walk me through how long, I presume, was it 1 or 2 years?
Oh, no, thank God it was only 9 months.
9 months.
And the place was always in confusion. You never knew what you were going to do the next day. It was the most interesting experience. But I think the best thing I took away was there are all sorts of people. And just remind yourself when you're lucky that you're extremely lucky.
You attended the University of Cape Town and graduated with a Bachelor of Commerce in 1971. Where did you see yourself heading?
Well, there was a lot of turmoil at the time, and the anti-apartheid movements, the students were very active, just as they were here at the same time, and it was true in Europe. And so we were never clear that the future was going to be anything but difficult. Sorry, putting it better, we thought the difficulty was about to emerge. So I immediately went to Britain after my BCom, and then found a job there. And even there was a lot of unemployment, so I was lucky to get a job. And I just felt that from a young age, I always thought, because of this background I mentioned, wealth was always created by industry. It wasn't government. It wasn't legislation. It was all about what individuals did and the drive and tenacity they brought to their actions. And so I worked in London for a wonderful teacher, and so I got really good, started to understand what I was doing. It took me another 6 years to really understand, and probably even longer.
Your first job in London, 1971, 72, I think, when you moved there, late 72. What was that like? You'd never been there before. What were some of those experiences, and what was that first role?
It was exciting because you were in a completely different country. There was freedom. We didn't have the church and the government breathing down our necks. So it was like being on holiday. We worked hard, and as I say, I had these wonderful people I was working with, and so you felt you were learning. You thought you were making progress, but I was paid pitifully little. But that was your apprenticeship. So you never had any illusions or any money, but you had a lot of fun.
London in the early 70s, early to mid-70s, was clearly going through a turbulent period, high inflation, industrial unrest, oil shock, and a sense that the post-war economic order was shifting. What was it sort of like living and working in that environment where there is so much happening?
Well, they didn't know how to deal with the economy, and so we had rampant inflation, and so they brought in price controls and wage controls. I mean, you look back at it and you think this is not possible. And about that time, my grandmother she died a couple of years before, and there was these death duties that were levied. She paid 87% in death duties, or her state did, but there was a trick. They took the capital gains off the top of that. So they'd calculate your death duties on the gross, and then they'd slice you again. So what had been quite a nice fortune became pitifully small, which my brother and I shared when my father had died, around that time. So we sort of thought, we might be able to be lazy for the rest of our lives. It never happened.
In 1976, you then returned to South Africa and joined a company called Sage.
Yes.
And then in 78, moved to another company called Anderson Wilson, where you eventually headed industrial equities research. How did it feel coming back from the UK back to South Africa, and take us inside some of those early roles and your advancement through those firms?
Well, I'd gone back to South Africa because I figured I wanted to make a certain amount of money, and then I was going to leave South Africa. So I was working for Sage, and the fellow I was working for was dishonest. So I went and approached Anderson Wilson. I said, "You're fantastic on mining research, but you need someone to take you through this industrial world." And I said, I need one assistant, an appy, an apprentice, and I needed someone to type up. I couldn't type. And they thought I was empire building. I thought, gosh. So I went and worked for the biggest broking firm. And then they saw that I was creating, or whoever we were creating quite good reports and getting a lot of business. So they came back and they said, well, come and work for us. And within 6 months, I was offered a partnership, which was unheard of in those days. And partnerships were quite binding. You didn't enter into them lightly because you felt obligation to your partner. But I didn't take it, and it cost me a lot of money because I knew I wasn't going to be there for long. But it transpired I was there for 7 years, whereas I thought I'd be there for a couple of years and make the target amount of money, which I shan't reveal to you because you'll just laugh at me, and before I left. And then, so that was the place. And but it was an exciting period because we were writing quite interesting industry reports, which wasn't the pattern of the day. So we sort of innovated with the idea that you can't look at a company, you need to look at the whole industry. And we'd then go onto the phone and speak to the leading fund managers of the day and sell our idea. Invariably, and this was a strange thing, invariably it would be out of favor stocks and industries. So we had sort of alluded to these just as a natural evolution. We were always, it was DNA, it was having a contrarian fundamental view of the world. That don't trust experts, think for yourself and work out where the gaps are. So that was fundamental. Anyway, we moved our market share from about 1% to over 3%, which in a broking business is huge because your costs don't change. And but unfortunately, I said, look, I'm now getting too comfortable here. So that's when we decided to move. And then we got married, and then we had our children when we arrived here.
You've mentioned previously that you were in a hurry. You're a young man in a hurry. Why was that?
Oh, too much self. Too much self, yeah.
You moved to Australia in 1983, but I think you first came in 82 to secure the job. Joined Bankers Trust. Walk us through, Australia at the time. What were your first impressions, and then that early position at Bankers Trust?
South Africa at that time was booming still because the gold price, and they had quite a lot of fundamental industry. They were the biggest economy in Africa by far. So the currency was actually stronger. South African rand would buy more than an Australian dollar or a US dollar. So we came here, and what we were surprised was, in some areas they were quite behind where folk were in South Africa, and the reason is pretty plain. South Africa to Munich or London is a 9-hour flight, and vice versa. So you always felt connected to Europe. And when we came here, there was a connection to the old country, as it was called then, but there wasn't that immediacy. And so a lot of things hadn't changed very much, as much as they had where we were in South Africa. So when my wife at the time was working for Grace Brothers, I mean, she was completely changing their processes of advertising and display. And likewise, I came in with certain ideas which were a little different to what was being used here. So we were slightly ahead in that. But the big surprise was that the living standard was approximately the same, even though I'd taken a 2/3 cut in income. But housing, London housing was cheap next to Sydney housing, and we were just staggered. Anyway, we got on the ladder, thank goodness.
How hard was it? You obviously had, no network here. I think you'd met Australians on a sort of a Kentucky tour when you were much younger. But how hard was it when you first moved here to sort of fit in and gain acceptance, whether it was with colleagues or just sort of working your way into society?
That's the strangest thing. Wherever I've worked, when I was living in London, when I came here, the generosity of your work colleagues is just remarkable. Here you come with your snotty ideas about what should be done, what shouldn't be done, and they accept it and put up with you. That's been my experience. It was lovely here. And, Olive and Ross, who ran Bankers Trust, that division at the time, couldn't have been better. They were very obliging. And, we were working hard to try and catch up. And there was a sense of catch up because of their drop in income. And just the fact that you're now in a new country, and you've taken quite a financial hit. And I was never worried about status, but I was interested in spending power. And yeah, that was a huge hit to spending power.
What was the state of the economy like here in Australia during that time? You arrived in 83, so those first 3 or 4 years, how were you finding things?
It was great because when we came, everyone was obsessing about the contrarian cycle. It was the obsession of the day. And so it was very brave of these guys at Bankers Trust to employ me, because everyone was starting to feel the world was now coming into this massive downturn. Anyway, they weren't interested. They were building a very good business at Bankers and getting more and more mandates, wholesale mandates. So I went in to help them there, but they realized I was no good to them because I wasn't a macro player. So they put me in charge of a thing called the split trust, BT split trust. And there was a change in the tax law at the time. So if you were a trader, you basically paid income tax on all your gains. And then, you needed to show that you would hold a stock, buy and hold, which I sorted. It was perfect for my style of investing.
The 87 crash came, and you've said that it was a bit disappointing how unprepared people were because the warning signs were already there in the lead up. How did you see that coming? What was your foresight, and how did you navigate the business through that when you were running the retail operation at that stage?
Well, Olive and Ross understood the markets were super hot, and I could see it as well. As I once mentioned, that you could make a facsimile of BHP for half the price if you assembled a steel maker, a iron ore miner, and so on. It was hugely overvalued in terms of sums of parts. But where I was fortunate is they were playing around with futures, and so we started to participate in options. And so I didn't understand anything about options. It was way above me. But we had this fantastic fellow, Vincent, and he understood it. And we put these trades on in 87. So it protected us. And we actually made a lot of money that year. But it was understanding that there was just unusual heat and it wasn't justified.
Looking back on 1987 now and the crash, what stayed with you the most? Was it a case of how quickly the market changed, the reminder that prices can drift a long way from reality, or just that responsibility that you're looking after other people's money, not necessarily just your own?
That was the key thing. And I remember there's a Bankers Trust employee who had money in our funds, and he was in complete panic. And I remember so clearly literally begging him, to just leave it. The destruction had occurred. And in our case, the first couple of weeks, the fund was only down 11%. I think the market was down 30-40%. And, but you couldn't, the palpable fear was such that I just couldn't convince him. I took him through all the logic. I said, look, this has already happened, it's too late. But he didn't want, he was shocked. And that was the trouble. And at the time, international investing wasn't that fashionable. The idea was you owned property or you owned Australian shares. I think imputation came a bit later, came later than that. But when imputation came, the love affair with Australian shares intensified. But property was always the big go-to. So we had introduced this idea of global investing, which was quite foreign at the time.
By the time you left Bankers Trust in 1993, after a decade of being based in Australia, you'd already built a formidable reputation at BT. Did you have an idea in mind at that stage of what you wanted to go out and do? You wanted to start your own firm. Did you have sort of the foundations of what you wanted that to look like?
No, there was no future plan because I'd been with Bankers for about 10 years then. And the problem was I was getting overwhelmed by new flows. And the money just kept coming in. And I'd started to talk to the management saying, well, why can't I have more say in how we split the spoils? And I had a very reasonable arrangement that I proposed to them and they ignored it. And then one day, a young person came into the office and said, Kerr, we wanted to do this presentation. And, I was working extremely hard and we were producing numbers which were twice the index, twice the competitors annually. When the market was doing 11, we would do 30 or 28 or something, and across the funds. And Paul Moore was running the American fund and he was doing okay with his financials and what have you. But I was doing the other funds. And so she came in and, she caught me on a day when I wasn't wanting extra stress. I said, what more do you want of me? Do you want me to walk around the office, which was a term I'd learned from Anderson Wilson, with a broom up my ass to sweep the floor? Very crude. But I was so furious because there was just endless demand. So I was forced out in my own mind because she said, oh yes, well, we'll get someone else to do it. And I thought, when I'm completely broken and destroyed, I'll have on my epitaph, he couldn't make it or something. But so I said, I can't negotiate with these guys for a cut of the action. It wasn't for myself. I was going to get some of that if it was done, but it was all about motivation of the team and keeping the focus clear. So anyway, they weren't interested, so I then left. But the most shocking thing was, so I had this discussion, at about 9 in the morning, and I was locked out of the building. And that's a very interesting psychological effect when you're actually denied access to something you'd been reporting to, for 9-10 years. That was a huge sort of shock to me. So I immediately within 2-3 days, got on the plane and went off to New York to see if George Soros would port the money that we had been managing for him across to my new venture. But there was no great premeditation. I was starting to think about going on my own, but there was no premeditation other than saying, well, if this goes on, I'm just going to be hammered.
George Soros, of course, the legendary American investor. How did that relationship start and how did it then form?
Well, that was interesting because we were doing so well, the management thought we could take in external money. And I thought, well, that'll be fine. I'll run this money because, it'll enhance my position in the firm. So it was all, obvious. And he came in at a most extraordinary time where we were going to Latin America. Bond had bought Chile Telecom, and that woke me up to what was going on that continent. And what was happening is you were removing all the burden of state, and stuff was starting to be privatized. They started to remove the protectionism. And it was like had happened when Bolivar, threw out the Spanish. It was a clear change in the history of this continent. So we started to invest there. And when we were going to places like Brazil, they had inflation of 1,500%. So every day you're having a problem with your accounts. But we knew it was starting to come under control because they were starting to introduce competition from abroad and so on. And the markets, each of the markets we participated in basically went up by about fourfold in a year and a half. They were just colossal bull markets. And we participated in that. And with the Soros account, he came in November, and I think he gave us 37 million. And by the end of that, 13 months later, that figure had risen to close to 138 or something, 138 from about 37 or something. So he thought I was a genius. So I thought we were going to New York, I could, extract a rent from the experience he had had. And he kindly said he'd put money into the fund, and he'd transfer the money, but he wanted a partial ownership in the new firm. So we gave him, he wanted 25%. I said, no, we'll give you 20%. And he wanted certain other conditions, but he fronted up with some money. But it was so funny because here I had been working for quite a while, and he presumed I had several million, not just a few million. And he said, oh, well, you can put in a couple. And I sort of looked a bit aghast. And, I was too proud to say, well, that's going to be a stretch. So I said, all right, I'll put in something or other. And he kindly got us started. And the deal was that he'd have ownership for 10 years. And we cut the deal where we would not take any income other than our salaries. And after that, we'd all share in the profits. So there was no front loading by the staff. And it was, in later years, his financial controller, he said, Kerr, you were the only people we came across who hadn't dudded us. And I was so proud of that because, the generosity to put trust in a young twerp. And then, he did fine out of it. He did very nicely. But it was the trust that he gave. And of course, he gave us credibility as well. And then there was a person in New York at the time who said, all right, well, could we enter into a contract with you as well? And that started the Optima arrangement. And at one stage, they had raised about 1.5 billion for us. So it was a big open play for us.
The firm was founded in 1994, Platinum Asset Management. What made that moment feel right? And then what about the initial structure of the firm? You mentioned Soros there, but what was the mandate that you wanted to do? What was the sort of strategy? And then what about the structure of the personalities as well?
That was the key. the four people on the investment side, so it was Andrew Clifford, Jim Simpson, and Toby Harrop, they were all money makers. So we all were very clear in our own capacity to win in markets, which is unique. Having four is very unusual. There was a complete understanding of our objective, which was to create wealth for our investors, and by so doing would enrich ourselves. But it was the client first, and then there was enrichment. And we said, what we're doing is so sensible by buying companies that other people are discarding, and it was largely a misunderstanding of the quality of the business and also a time arbitrage. It gave us an edge, and we thought this was so obvious. So we set the business up, and we were running the money for Mr. Soros and others, and but we weren't getting much money in the door. So we were very pleased. We got an invitation from the Catholic Schools Fund, and they said, well, come and talk to us. We hear you've got something to say. So we had this meeting, and I gave what I thought was a brilliant presentation. But I wasn't seemingly getting through. So I went up to one of the very kindly looking priest after my presentation during tea break. And I said, well, what did you think? And he looked at me and he examined me for a while. He said, I didn't know what you were going to say next. Because all we were trying to do is saying, the obvious is priced for the obvious, and you've got to do something else if you're going to make money. Anyhow, then we were approached by MLC, who kindly agreed to have a marketing agreement with us, and they would do the marketing and we'd do the presentations and run the money. And that proved to be a very good start, because that put us on the map, because they were very proficient marketers. They understood who to influence. They understood how to get access to pools of money. And they'd cut a deal which was quite harsh on us, but we worked out. We understood branding, and we understood markets, and we understood communications, because we'd always had a style of communication which was pretty upfront and acknowledged errors. And but they had the way of getting people in front of us, because it was a big ask. We were asking people to do everything they knew intuitively they shouldn't do. Buy things that were obviously wrong. They couldn't make that connection between the business and price. They always locked the two together, and of course it was the problem. So to try and convince people to be counterintuitive is not easy, because they lose sight of the fact that that's the business story and this price. If the price is down here, it makes total sense. If it's up there, it makes no sense. They couldn't make that linkage. It sounds very obvious, but it's true.
Platinum quickly developed a distinct temperament, global in outlook, sceptical of benchmarks, comfortable protecting capital, and willing to look different for long stretches. Is that something that existed from the outset, or was that something that evolved over the early years?
It was the confidence of earlier success. As I said, the numbers we had at Bankers Trust were spectacular. When I went to New York with these charts, Pacific Basin Fund compounded for 7 years at 34%. They just couldn't believe the numbers. But we were so busy, and this is not false. We were so busy that we didn't have time to think about that. We were just trying to win. And so it was all about just playing.
The business always seemed uninterested in doing things simply because the industry did them, as you alluded to there. In practical terms, how do you build a firm where independent thinking is genuinely protected?
Oh, I was lucky. I mean, in life I've always had people around me with much greater ability. So two things come out of that. Firstly, you learn a lot. But secondly, you treat your peers with respect, because you know they're better than you are. So it's not difficult. If you've got the right team with you, and building a team, as I say, it was fortune. It was good fortune. It wasn't entirely. I mean, I knew they were sensible, but it was good luck. There's always luck in business. These business plans, as I say, Had MLC not come along, we probably would have stumbled along and gradually built the business. But they gave us the big acceleration. And then, in 2000, we had an extraordinary period where from 2000 to 2002 or 3, we were up 57%. The market was down, we were up 59%. The market was down 31%. So we had outperformed by 90% in that 3-year span. So that's when the money just flew into the business, because suddenly they said, oh, this international investing is interesting. So that was a shift from purely Australian. They started to get used to this idea. And the second one was, these guys seem to know what they're doing. So it was a confluence of good fortune.
The business, and correct me if I'm wrong, I think it had $2 billion in funds under management in the year 2000, and then by the time of listing in 2006 or 2007, it had $26 billion. How did you manage that level of growth internally?
Well, very badly, and that was all my fault. Because what we did is up till 2011, all the ideas were siphoned upwards and through myself. The trouble was, as the funds got bigger, we hadn't adjusted our mechanism of control. And so we then, in 2011 and tentatively in 2012, had established small groups to try and deal with this overload of information, because we were covering the globe. And the idea was that they would produce their best ideas, presented at a Thursday meeting with the CIO, who by then was Andrew Clifford in 2013. And the idea was to pull those ideas together and put them in the different funds. But we never got the discipline, because by this time, the group was more dispersed. We're now about 25, 24 analysts. There was, I couldn't believe it, but apparently there's some confusion about, what was our purpose, which, we'd always very clear about, which was serve clients. And so you start getting that fracturing. And the biggest problem came from a very simple notion that as a fund manager, you shared responsibility for that idea with the analyst. The trouble is, as the group got bigger, that sharing became a problem, because who is responsible? And the analysts, the good ideas was their responsibility, the bad ideas was the fund manager's problem. So that started to create some problems. We were still matching the market at that stage, but we had lost that energy, that superior notion that if we go hard enough at ideas and work hard enough, we'll get there. So now we were starting to become much more institutionalized. And I've seen it in this industry. It wasn't just our own experience. I've seen it across other companies in different countries as well. It's to keep that, Bezos talks about it, start up every day. And we were starting to lose that. And it is true that we probably had underspent on, infrastructure and backup. But it was the way we were built. And the same problem happened at Bankers Trust, because they were all, seeking to make money. Compared to Macquarie, that's why Macquarie succeeded and Bankers didn't. They were all about systems and what have you, whereas at Bankers Trust, there were really strong people who would just drive things. So in financial services, the Goldmans and the Macquaries have done the best work, but they're brutal in terms of hiring and firing, I think. That's what I would observe as an outsider. Whereas we were much more forgiving and said, well, he's got to learn, so give him a chance or give her a chance. So it was always a more forgiving. And I think that doesn't scale well. It works when you've got a small group, but as soon as you start scaling with that mentality, I think you've got a problem.
Do you think there's a level as well where perhaps, or whether it's financial services businesses or funds management businesses that have a finite lifespan, they're not going to be around necessarily for generations. They might have really strong 10, 15, 20 years of growth that start to plateau and then they, fall away after. I mean, we've seen examples of it recently here in Australia.
I'm almost certain that's the pattern. I think it's very unusual to not see it. I saw it when I was working in London. I've seen it elsewhere. And what actually happens is what I call the inheritors take over. So they don't have the excellence of the initiators. They've been well paid. They inherit this mantle of excellence, but they haven't earned it. And my experience is that they're very quick to dress themselves in this mantle. And they can't really explain what made the firm strong in the first place. But they know they've done a fantastic job. So that's your problem. I've not seen an exception to that. So I think, and it's true of ordinary companies, finance is even, I think they've got an even shorter life than really great industrials, because the great industrial companies, they keep migrating into peripheral areas. And if they're expanding, they will drop what they did before. And you see it particularly in the Japanese. I mean, they're past masters. That's why they have the oldest companies in the world. They go through very soggy patches, but they're neurotic about surviving as an organization, which is rare in the West. And so you see these companies morphing. You see it in Europe, but you don't see it so much in America. You're seeing it now. And AI is giving an extended life to companies like Microsoft. Without AI, I suspect Microsoft would be quite boring now.
In terms of your investment approach, you've often said that the crowd's behaviour leads to imperfect pricing, which suggests you've been as interested in human psychology over the years as in company analysis. Do you think the edge in investing, at least from your perspective, comes from understanding how sentiment can shape price?
It's fundamental. You need to understand the operations of the engine room, as I call it. What are the key variables that this company has to get right to have a right to extract a rent? In other words, its profits. What is this? What separates it from the field that allows it to make that spread? You have to understand that. And then you need to address price quite separately. It's quite separate, as I said earlier. And there you have to say, well, what is in the price, what isn't? Are they making too much of a fuss about the near-term events? And that is invariably the problem. There's this obsession with short-term performance and this indexing. And now with all the ETFs, which I'm a huge fan of, your problem is you don't know when to get out. And in the meantime, they're creating all sorts of pricing distortions because let's say I start a water ETF. That's fine, except, I'll run out of real water stocks, and then I'll throw in a few pump makers and I'll throw in a few engineering companies who, get 5% of their business in this, but I'll distort that whole field around it. It's like a sort of magnetic field that I distort. So it really does offer, paradoxically, ETFs are offering, just when people are giving up on stock picking, are offering great opportunities to stock pickers. It's quite a huge paradox. And that's why we're so excited about what we're doing at the firm, because we're supporting this young man who's starting his own long short fund. And he absolutely exploits this, but he's using quant. He's using quant with great effect. And so this year is up, 12.5%. Most of the long short funds are down this year. And it's simply because he's using neglect and very good quant, because without quant and AI, I don't think you could survive. So even in our fund, we're using a lot of AI to help us analyze and shorten the whole process. So you go to a new industry, you can prompt quite quickly and get the essence of the industry. And you'd want to do some of your own research. You wouldn't want to rely on that entirely, but you'll be surprised how. And particularly now when you've got experts of experts, you can get a very good picture of what's going on in that industry. But it is about making those matches and saying, what is the market obsessing about? Is it legit?
You've also said that it isn't enough simply to be contrary because the market may be seeing something that you're missing. How do you train yourself to question your own conviction, particularly when you're so hell-bent on your view being right?
It's a very nice question. You need a bit of humility, and you must not have written a 50-page report. Those are the two things. Once you've written the report, you're gone, because yeah, you've just sold yourself the story. So what we do is we ask for a thumbnail sketch of an idea. And that's when we'll decide whether, and we'll put a lot of work into it in one day. We'll use AI, we'll do this. And then you say, no, we're just having ourselves on here. So you don't go too deep at that stage in your commitment. You're simply saying, this is one of many ideas. We like it in shape, but the real problems are these various factors. And it is a question of judgment in the end. You can't know you're right. And as I've been saying, the really great money makers invariably feel the most uncomfortable when you make the call. I cite GE, which had been built up by Walsh. He'd taken it in all sorts of bad directions. There was a cleanup, a really good person put in charge of the engine division. And there were only 2 or 3 big engine producers and maybe a fourth you could count. So it was almost an oligopoly. And we bought it quite enthusiastically. And I think it gave us, with the spin-outs and what have you, maybe it gave us 18-fold increase. So when you get it right, but it didn't feel good at the time because you had these counterclaims from the financial businesses he'd tapped on, because all he was doing, and it was so apparent to us, and we were very clear about it, he had just talked about meeting your quarterly numbers, and that's what he gave to his successor. And we knew it was manufactured. And you heard, you listened on the calls, you could hear how they were cutting back on research and development. And it was all about development, not research anymore. And here's one of the great companies of the century. And it starts to winnow away at the important parts that built the great engine house.
You've also spoken about availability bias, the tendency for investors to overweight whatever's loudest and creating the most noise in the market. Did that insight come from watching and observing cycles over time?
Yes. We just have the need to make these false linkages, so-called heuristics. We have this desire to find a pattern. Pattern finding is our great superpower, and sometimes it's completely misplaced.
You've often been drawn to neglected businesses rather than, fashionable ones. What, in your mind, is the difference between a company that is merely unloved and one that is unloved for good reason?
That's very difficult to answer because we are always voyeurs. We do not understand what the real day-to-day issues are in a business. We can guess at them, but we are always outsiders. What you're really looking for is consistency of what is uttered and what is acted upon. That's the first giveaway. And you're trying to find some cohesion in what is pulling everyone in the same direction. In America, that tends to be the share pool, the stock options and what have you. But in other countries, that's far less of a driver. It's about the excitement in being a successful company. When I first went to Bankers Trust, I remember one of the auditors coming up, he said, we've never seen a company like this. He said, everyone just wants to get on. And it was that ethos, that excitement. Bezos talks about it. It's evident in some of these AI companies. And you can sort of pick it, that everyone's moving in the same. I don't think Altman's company has got all those things. I think they've got some problems by just being an observer. So there's a case where I could be proved completely wrong. But Anthropic looks to me, not because it's a winner right now, but Anthropic has been pursuing its own agenda very quietly, very deliberately, and looks to me like it's doing the right sort of things.
In The Beautiful Game, which is a text that you've written, you describe price as both everything and nothing. Everything because it drives returns and nothing because it can drift away from reality. How do you balance that as an investor?
Well, it is everything and nothing, because if you pay a silly price, you're not going to get your money back, or as much of your money back as you gave. But if you don't understand the business it is nothing because it's not going to help you. So the prices will mislead you. It won't help you. And as I've said often is that when you're a novice, you use the market price as an adjudicator of whether you're right or wrong. So you've bought a stock, goes up, you know what you're doing. When you've been in the markets for a while, you treat price a little more with more circumspection. You start saying, yes, there's a problem here. The market doesn't concur with my view. Once you're and you go back and do more work. Once you're a real professional, you're not interested in the market's price per se. You're interested in the business. You look at any changes in the business, and that determines what you want to do with the price. You're given a warning by the price if the business is in trouble, but you then go and do your work, and you don't necessarily concede to the market that the price that they've chosen is correct. But getting people, I've been talking about this now for a few minutes, getting the people to separate out price from the business is impossible because you go into an apprenticeship with a firm and everyone's talking about the price. It's very hard to go to an investment house where they're not obsessive about the market being approximately right. And most of the time it is. It's an approximation of the value of the company. But it is driven hugely by availability and short-term focus. It's most peculiar because, the higher it goes, the more conviction grows. You don't become more enthusiastic as the price of your car goes up in price. You actually start rationing yourself and say, I'll have to trade down to another car. But no, in the market it's the opposite. You become terribly enthusiastic. Oh, I'm right. Look how the market's endorsing my position.
One more before we move on. When you're looking at a company under pressure, what is it that you're really searching for beneath the accounts? Is it competence? Is it incentives? Is it the quality of the founder or the management team or something else?
It's for inconsistencies. Just look for those inconsistencies where they're saying something and it doesn't conform, or they've lost a couple of good people. That's a very interesting thing. What's been happening on the board? Until I had experience with bad boards, I never understood how bad they could be. And one thinks the business is run by the board. It's actually run by the operating management. And my own view, gratuitous here, is you should have tiny boards where they keep the management straight, and the business should be run. And it is run by the management, but most of the input, most boards are back-scratching operations where there's not a lot of insight brought. They can bring an outsider's perspective, but most of it's very sort of generalistic. It's not precise in terms of the needs of that company. And so that's why you see so much follow my leader. That's why, a bank decides to go into mortgage broking or goes out of mortgage broking, and then they all follow. So there's a hell of a lot of mimicking other people's activities. And that is a condemnation of boards, in my view, because it shows how they're just talking to their mates over golf or whatever. I never played golf. I didn't have the patience. And, you'd pick up all the stuff that wasn't going to give you a better business. But they thought they were making a contribution. And they are picking up 200, 300,000 a year, so they need to feel useful. It's a terrible system.
After more than 5 decades in markets, London in the inflationary 70s, the 87 crash, tech bubble, GFC, and then some of the extraordinary technological transformations that we've seen since, what does investment excellence actually look like to you, stripped of marketing language and mythology?
It's the ability to persistently take advantage of a changing environment, reading it, and as a consequence, having returns that are superior to the market. You have to be able to do better than the market. And that requires you to be able to, it requires a lot of flexibility. And take the moment here, and I won't go into it, but there is a break in world alignments. You need to understand that. How it will figure out, you're not quite sure, but there's a complete change in the significance of some countries versus other countries. And that will mean that we'll have trading blocks. My biggest fear is that, some of these lovely companies we can own in China, we become forbidden to own. So you can create your own portfolio, like we saw with the invasion of Ukraine, suddenly you're banned, or if you have holdings, Russian holdings, that they're locked up. So that's my great fear for the moment, because of this antagonism we're seeing, and it'll develop as this crisis in the Middle East unfolds. You'll see China becoming more assertive and America having to find space for the new hegemon. But so you need to be able to adjust. The answer is you need to be able to adjust with the times, and you cannot look backwards in regret. You have to say, are we going back to where we were? And it's very unusual that you are. How do I read these new circumstances?
When you think of the truly great investors you've known or observed, is excellence primarily about intelligence, or is it about temperament?
As I told you about the fellow at Bankers Trust, you couldn't calm him down. Temperament is very important. And because it's you're using OPM, other people's money, you can certainly be quite inflated in your own ability, because you have no consequence. It's a unique industry. You have no consequence of other people's loss, for losing other people's money. So you absorb all the accolades and then shuffle the losses to someone else. So you need a steady temperament and an ability to understand how much luck you've had, how much judgment you've had, and always overload on the luck, because it'll keep your temperament and your ego more or less under control. Without controlling your ego, I think that's the biggest destroyer in this industry. People start thinking they're good.
You spent a lifetime studying businesses, not just stocks. What does it actually take for a company to create enduring value rather than just a temporary burst of growth?
Is the culture. So the innovation, if I think of the great industrial companies, which still exist, because we're now all software and a digital world, it is about imbuing newcomers to the company with this idea that this is our mission to, and the Japanese do it well, to serve society, and that's how they try to coalesce everyone around an idea. They talk about their societal benefits, which is good, because most of us respond much more to great ideas than to money, peculiarly. We actually delight in a greater cause. And so I think the Japanese do it quite well. They're a bit inclined to promote without excellence, but that's starting to change. But in the West, it is about imbuing people with the purpose and the joy of, the great companies. It's about the science they're evolving, and then the way they execute. And there's a certain way to do these things, and you can't do it. You can't take shortcuts, and you've got to reinvest in the business. And that's why some of those Europeans have been so successful, because it's reinvesting. And it's a bit of a problem I have in America, because the stock options and the emphasis on free cash flow can derail that longer term focus.
When you look at a business today, what are the most reliable signals that real sustainable long-term value is being created?
It's been able to see that culture at work. It is that, yeah.
Before we move on, what is the greatest risk in investing from your perspective?
We've had this pretty long bull market now, and you then start extrapolating, and you instead of widening the likely outcomes, you start narrowing them. You think, oh well, this is normal to have compounding in the teens. That's your greater risk. It's what we call path dependency. Your path becomes ever straighter. In fact, it should become more crooked in your thinking.
You've built one of Australia's most distinctive investment firms and influenced how many serious investors think about global markets over the long term. When you consider legacy, and we'll get to what you're doing at the moment, but what do you hope most endures?
I just think integrity, the importance of what is your intent, and do you pursue it with enthusiasm? Integrity is very hard to manufacture.
When people speak about your career, obviously they're going to focus on performance and your level of wealth, but What contribution have you made that you're most proudest of and that you want others to remember?
There are lots of things that I could tell you. One is that I've probably paid over $1 billion in tax. I say that with some pride because as a migrant, one feels very grateful for being allowed to come here and live here. So I think that's one thing I'm quite proud of. And I'm proud of the wonderful things my former wife has done with philanthropy. She's given huge amounts of money to arts, performing arts, all sorts of things. Projects that are quite extraordinary in their creativity. And, this journalist thing that she started and hadn't kicked off well, now she's trying to revamp it. So she's been doing fantastic things. And then with our foundation, we've been doing, small things by comparison. So I'm pleased with that. The problem with it, though, is, we give away quite a bit. Or it's not giving away, it's just making contributions. But it's having impact. Finding projects that really have impact is not easy. So we help what we think is useful stuff like, bringing First People into a better environment for education. And that's one of the things I'm most enthusiastic about. We don't do much in medical because certainly not in drug development, because I believe that's well covered by the profits they make. But in terms of, I think that the central theme is how do we create a more inclusive and welcoming society? How do we get the benefits of diversity and not look for differences? That's the biggest thing we'd love to succeed in. How do we get everyone on board in a single direction instead of saying, well, I'm this or I'm that? And it's the world at the moment, and it's particularly polarized in some countries, and it's not helping them. And we should learn from that.
The Neilson Foundation has over 300 million in assets now. It's donated hundreds of millions of dollars over the years, set up in 2007. Why is philanthropy so important to you?
It's what I learned as a young person, is that with privilege comes responsibility. And to say, oh, well, you pay all this tax and why should you make more of a contribution? If you want to live in a civil society where you don't have barricades protecting you or watchmen or whatever, you need to share. This idea that everything, the two ideas there. One is that it's all about you, who's made it. You forget all the people who've helped you. No, it's all about me. And that's the one thing. And then just the understanding that not everyone's had that break. And if you don't understand that, you're never going to be a great citizen, because self becomes everything.
How do you define personal success now?
I don't know.
What did success...
Making it for another day, live alive for another day, I don't know.
What about success? What does it cost you, whether it be in time, relationships, ease or innocence?
The cost was, Judy fired me because I was too busy. And that was a huge cost because, it didn't help the family in sticking together well. So that was a very sad event for me. That was a cost. But otherwise, it was missing a few holidays with the family because I was working quite hard. You can't, in this game, you can't just run a 9-to-5 existence. You've got to surrender a lot of time. And that's true of all the people I've ever seen as serious investors. But otherwise, I have only that as a regret.
Proudest achievements?
As I said, I'm very proud of what Judith's done. And I'm pleased that we've got the foundation there to try and make a difference. But it doesn't really make a big difference. It helps a bit.
What are the biggest hurdles that you've had to overcome? What have they been, and how have you been able to overcome them?
The difficulties are always around herding people in the same direction, because humanity doesn't change, and selfishness is in our DNA. It's why we survive, probably. So that's the challenge you have, trying to get other people to sort of not see the world your way, but having an empathy for the need to show more generosity to others, because there's nothing more attractive to most of us than standing on the neck of someone else, and trying to minimize that way of thinking. It's not easy.
What keeps you busy at the moment? Obviously, you've got Argyle Funds. Tell us about how that business was established and what the focus is and who's involved.
Yeah, so when I gave up platinum in 2018, I needed to start looking after my own money. And so we set the business up, and it's really just been about building a small team of proficient money makers and running equities. The problem we see is that there's a long-term bias towards excessive money creation. And the one area that will protect you is by owning the source of wealth. And the source of wealth is businesses. And there's only one time when you need to be really worried about equities, and that is when there's a change of regime. And ironically, even now you're starting to see a small slither of that with directions from the White House in America, where you should be not doing buybacks. So you get a warning. You've got plenty of time. There's nothing happening, don't worry. But that's what you've got to look for. What is, we need to find long-term assets which are protected from this money printing bias. And it's getting worse, with a 37 trillion of debt out there in the US. This will continue to grow. So you need ways of protecting yourself, and one of the ways is to own gold. One of the other ways is to just be in good equities, which are fundamental to that economy. So that's why we've been putting so much effort into it.
When you think back to the 13-year-old boy buying his first stock back in South Africa, what would surprise him most about the life that you've lived?
Because I was so spoilt and lucky, not much. I always hoped I'd be able to live reasonably well. I never saw it important to make a huge amount of wealth. But what I did know is that to be at the bottom of the pile was something one should work quite hard to avoid. That was actually, it was more a defensive position rather than a promotional, deterministic position I took. Just protect the downside and that's probably how I think about markets and investing. Protect the downside to some extent. And it creates problems for you because you should just stay with these trends. But I'm always saying, well, you don't know when they come to an end. And you look at environment now and you wouldn't have a clue whether it's going to go up or down.
You arrived in Australia in '83 and the market was far more domestically focused and insular. Over the decades, it's obviously opened up. You've been at the forefront of watching the country become more globally integrated, more financially sophisticated, and far more dependent on asset prices. When you stand back and when you look at Australia today, do you see a country with strong long-term fundamentals?
We've had a fantastic run. And the great dream we had when we came here was the extension of that generosity we saw in the early 80s, where, the country was going through a boom. There was quite good engagement with our neighbours. And I was always hopeful that we'd become a sort of beacon of liberalism in the Southern Pacific, but gradually becoming a big country in terms of population and then influencing and spreading the notion of representative government. We wasted so many opportunities in getting closer to our neighbours, and we're still doing it, and we're still arguing about where we should be setting our alignment. That is our big risk, I believe. That's where we're going to come unstuck if we simply toe the line, the traditional line about who we're allied to and whatever. And we need to find a way of living better with our very, very powerful neighbours, and I don't see us making much of an effort. So I quite worry about that because in terms of, I love this way we talk about the world's second largest economy. being China. I mean, if ever there was a misunderstanding, it is by far the world's largest physical economy in terms of, producing half the world's steel, using half the world's copper. I mean, you're not number two when you're doing that. And in terms of their military craft and so on, I think you'll find they're much closer to us in terms of technology than we'd like to believe. So, yeah, I think we need to have a very careful think about how we should align ourselves and where we should be spending our time. I don't think we've done a good job at all.
What does it take to be successful in life and in business?
I don't know. Monetary success is one thing. I think generosity of spirit. I think you've got to think of society as a vibrant, changing thing, and what can you do to try and assist? I think we're running ever more selfishly, and I think the internet is most dangerous because we no longer have access to a sort of centralized source of information and news. It's now we run our little lives looking at YouTube. It keeps sending us more and more confirmatory clips, and we lose sight of all the other interesting things going on in the world. I think that's a real risk. So yes.
What does the next 5 or 10 years look like for yourself? What do you want to achieve with Argyle, or what do you want to achieve outside of work or business?
Nothing much.
Seen it all. Kerr Neilson, been an absolute privilege having the opportunity to be with you today. Thanks for your time.
Thank you.